Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat. Paris milling wheat. In late May, prices moved down and away from arguably the most difficult overhead congestion on my daily chart between 267 to 270, where the market was capped and turned into a V-top. Prices headed low within a June-based, quite acute bear channel, exiting out at the gold long-moving average, currently 225, with nearby influence from the significant supports at 227, the now flatlining medium-moving average, currently 235, the bright red neckline extension of the June to November 2023 head and shoulders top, currently 237, and under the overhead congestion between 238 to 242, containing the March 2013 high at 240. Of all these, the two most important were and are the bright red neckline extension and the gold highlighted long moving average. Looking below, I said 10 weeks ago, and I quote, "An obvious area of support is further below, starting at the 50% absolute Fibonacci line at 219, and mainly centered around the old descending triangle on bullish half hesitation from April between about 213 up to the 50% absolute Fibonacci line. However, I can only point to this as an obvious spot, not necessarily a strong support." And that's the end of the quote. The market had in recent weeks hesitated, dipping, then pulling back up, forming a dark blue late June to date bear channel, currently 201.20 to 223, and that's verging on being a descending expanding wedge pattern. For this reason, I said here 9 weeks ago, and I quote, "V-tops, such as the one here, sometimes form a handle, sometimes, and this is very rare, they form a flat rectangle," end of quote. 3 weeks ago, part of this bear channel pattern, the earliest part, morphed into a mid-July to mid-September descending triangle, with the base on the May 2023 low at 221, and prices punched lower, with oddly enough a very small descending triangle that you can just about see on my daily chart around the middle of August. Now, before I deal with the downside opportunities of the descending triangle, I would like to recognize that the pressure in any V-top with an extension would be for lower prices, and so to the potentials below for the descending triangle. And as I said 3 weeks ago, and I quote, "There has been enough for me to lay out some potential targets below for the descending triangle. Thus, a primary target X will be down in the 212.5 zone, the secondary harder to reach target X1 down in the 204 zone." End of quote. Prices had dropped enough to reach target X and came ever so close to reaching target X1 before turning up 2 weeks ago. The move back up in the shape of a V bottom has been enough that I will retire the secondary target X1 and be satisfied with just the primary target. Last week I said, and I quote, "Overhead we have the 50% absolute Fibonacci line at 219 before we reach up to the base of the broken descending triangle, and the May 2023 low at 221. And that's the end of the quote. I'd also like to add the following resistances to that list: the dark blue upper bear channel line, the declining green short medium moving average, currently 224, the flatlining gold moving average, currently which you already know about, congestion at 227, the March to May 50% Fibonacci line at 231, congestion at 234 that is accompanied by the flatlining medium moving average, currently 235, and the bright red neckline extension. All this before we even see prices head out of the congestion generated between late June to date. Right now, I am still not convinced of the strength and validity of this recent rise, and I'll be watching closely to see if what I suspect may be true. Minneapolis wheat. Back in late February 2023, and especially at the start of April last year, so that is now outside the parameters of my daily chart, the market constructed a large bear channel that morphed into what is now my daily chart, a descending expanding wedge pattern, currently 679 to down well off the bottom of my daily chart. The upper trend line is currently escorted and reinforced, and has been for some time, though not very well recently I have to say, by the declining long moving average, currently at 671. I've kept this breached large original descending wedge pattern still on my daily chart, as the others that were here originating from August, September and October 2023 through to April 2024 have all been thoroughly broken, and this largest one is still there, even if it was breached as a just-in-case situation. Going back to the market action, prices turned lower for V-top at the end of May, heading down in a very narrow and acute bear channel. The market exited out of this pattern at the start of July, held up by a combination of the October 2018 high at 611 and the April 2021 low at 606, and most importantly, on approach to the green highlighted September 2019 to date uptrend, currently at 594, which held things up despite what turned out to be a breach last week and the week before. During the course of its time being held up, the market created what initially looked like, and still does, a more or less dark blue sideways expanding wedge pattern, currently 579 to 667. However, within the expanding wedge pattern, the market also created a cat's ears pattern over July. For those who are unfamiliar with this pattern, a cat's ears pattern is in essence a type of a double top pattern seen after a significant move down, so down and then double top. And that's such as the one we've seen in June. The pattern was triggered 2 weeks ago with a push and close below the neckline of the cat's ears pattern at 596. This was enough to lay out a potential below for the cat's ears pattern of target X in the 546 zone. Now looking below, I said 2 weeks ago, and I quote, "This green uptrend is perhaps the most crucial of all the support levels, as below we really don't have that much support until the December 2020 low of 542. That's the end of the quote. So you can see it all tied in together. And that's before the very recent breach of the dark blue lower trend line of the expanding wedge pattern. However, despite all these, the market turned back up last week, back up within the dark blue expanding wedge pattern, over the breached green uptrend, and importantly back up over the neckline for the cat's ears pattern. This move higher has been enough for me to retire target X after this commentary. However, it has not been enough, not yet at least, for me to consider this to be a fresh move higher. Overhead, we now have the congestion from January to March 2021 between 625 and 650, then congestion at 635, a congestion band between 650 to 656 containing the mauve medium moving average currently at 654, congestion between 666 to 676 containing the dark blue upper trend line of the expanding wedge pattern, the May-August 50% Fibonacci line at 669, and the long moving average currently at 671. All these together are also within a wide congestion band for the pre-mid-year V-top, formed between February to April, between roughly 635 to the May 2021 low at 676. These last 2 weeks have seen a significant recovery, but I have my doubts about the stability and the sustainability of this rise right now. I'm not writing it off, but I think I will need a lot more convincing, and it will need a lot more convincing for me to see this as a significant move higher. I'll be watching this market closely. London UK feed wheat. I'm sorry this daily chart is so colourful, messy and condensed. There's a lot going on here in a relatively narrow range. Okay, so the extension of the neckline of the May to June 2023 reverse head and shoulders bottom, currently at 195.95, has been an important and recurring dynamic level on my daily chart. It helped cap prices in early May, eroding the bullish incentive such that the market was ultimately capped later on in May by the August 2021 high at 199.20 and the March 2013 high at 205.05. Altogether, these created a V-top pattern with a very sharp downward slope that became, and here's the leap of faith. I'd previously asked you to make this leap of faith, and I do so again this week. The V-top became a V-top with a ghost extension that was caused with the changeover in early July. The construction of the second part of the V-top was the very late May to late June, very acute and narrow bear channel. This bear channel overcame all the congestions on the way down except the one at 164.95, just above the combined lows of July 2021 and May 2023 at 164 even. This congestion caused the market to exit out of the small bear channel. We then had a changeover gap, a large one, between 170.40 to 196.45, and we have created since a descending wedge pattern, currently 183.80 to 188.5, highlighted in purple on my daily chart. In mid-August, prices dropped away below this pattern but have not really moved away from it. And I'll deal with this shortly, but first I'd like to talk about the big, and it is a big leap of faith. It is to imagine this descending wedge pattern tacked onto the end of the small bear channel. So you have the small bear channel, and then we've got the descending wedge pattern moving down. Hope I managed to sign that properly. And thus we would have, as we have seen elsewhere in other markets, a V-top with an extension. Only here in truth it is not. Nevertheless, there was, from the break lower from lower mid-August, potential for lower prices, possibly as far as the June low at 164.95. And prices tried, but have as yet not yet fully confirmed the break lower. The move nevertheless gave potentials. From the descending wedge pattern, a primary target down in the 180 zone, the secondary harder to reach target X down in the 169.90 zone. The primary target at 180 even has already been reached. The price is pushing down and closing under the green short medium moving average, currently at 185.20. The dark blue medium moving average, currently 185 even, and for a while under the September 2021 low at 181.70. The 50% absolute Fibonacci line at 180.5, and even plunging below the combination of the March to May 50% Fibonacci line at 178.25, and the gold flatlining long moving average currently 178.5, and the bright red middle time of the recent, this is an important one, the bright red middle time of the recent, that's currently 176.75 of the recent late May to early July bearish shift pitchfork. However, and it is a big however, of these supports, many were pierced and breached, but we did not see any closes under them. They utilized their support to recover, admittedly not by much. Hence, though we have bounced, it looks right now like a bounce that may not be sustained. Hence, watch those supports again closely in case we see them tested. As below these, especially below the bright red middle time, we have the dark blue lower time, currently 172.90, of the significant early March to late June bullish Andrews pitchfork. This last dark blue pitchfork is the only bullish pattern, bar I suppose the gold long moving average, which is flatlining anyway, left on this daily chart, unless the market chooses to construct a new pattern. Just remember, the dark blue lower time rises each week by just under £1. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.